So let's take someone who's, let's say, is just getting started in their career. Maybe, they've got that first job out of college. So perhaps for the first time in their life, they've got a little bit of extra money. What would you recommend for someone in that situation in terms of how they approach, investing their money and presumably looking toward the future?
Who are you? And where are you going? What do you want? Together we'll find the ideal path on the Way to Wow Show with your host, Kevin Bemmel.
If you're going to invest, it's best to have a philosophy. Rather than just buying or selling on hunches willy-nilly, when you have a plan, you can invest according to that plan. Dmitry Fyborov is going to talk to us about how to develop that investment philosophy. But first, we're going to talk to Deanne Quinones, and she's going to make a cocktail for us, and I'm thinking it's going to be mezcal?
Mezcal, you nailed it.
All right.
How are you doing?
Good.
How did you know? Yes,
Because you're
of
the
course.
mezcal lady.
So
The whole production. Is the mezcal lady coming?
Is the mezcal lady coming? Yes, we cover mezcal. We talk about tequila and mezcal as agave spirits. So today I'm making a cocktail that I'm very excited to show you guys. It's the espresso martini. So this is very, very popular. It's having a resurgence. Typically done with vodka base, but we're gonna do a mezcal base today, just to kind of play around with it and just show some nuance. And this is we're gonna make 2 of these, right?
Yes. Well, and then you'll have to make some on the side for the team to keep them happy. We don't want, rebellion.
I'll be cocktail partying all afternoon.
Oh, good.
Here for the long haul. So we're gonna do 1.5 ounces of the mezcal.
Okay.
We will add a 1/2 ounce of the coffee liqueur here. This is really beautiful Caribbean coffee liqueur. So.
And that's for each cocktail, right?
For each cocktail, correct. So 1/2 ounce of a coffee liqueur. It could be anything, so if you have a Starbucks one, you can use that, or Mr. Black, or any of the newer ones you'll see.
Okay.
And then we're gonna use 1 ounce of fresh pressed espresso. So this is very important. You could use coffee, it's a trick to do something different, but you wanna use espresso because it's gonna have that punch and that power. So you want 1 ounce of espresso for each drink.
Okay.
I'm gonna keep you.
And I guess I was gonna say the caffeine will.
The caffeine will get you going, yes,
right.
exactly. And then we're just going to add a little bit of simple syrup. The coffee liqueur already is a little bit sweet.
Right.
So you're just going to add just a hair of simple syrup, about 1/4 ounce for each one.
Okay.
So we'll put 2 in there. And then that's it. And then the secret to this is the shaking. Because the sugar and the coffee liqueur are going to mix together and they're going to become frothy and it's going to almost whip together.
Oh, okay.
Yeah, so you'll see the texture is very important here.
So this is a little bit like an ice blended mocha without the blending.
Exactly. So yes, it's going to be like a frappuccino. So you'll definitely have to really shake it hard. You want the frothiness to come into the shaker. You want to see that it's going to be hard to hold because it's so cold. That's what
all right. This is like, you can have the margarita blended, or you can have it, straight up, and this is...
All of the ice is doing the blending here for you, so that's going to create the texture, like I said before. And the other important thing is that fresh espresso is going to create that texture.
Okay.
So you'll see.
Oh, yeah, wow.
There's no cream or anything, but just that shaking with the sugar and the fresh espresso will give you that beautiful frothiness.
Oh, and it's actually, there's a head on it.
Oh, yeah.
Yeah, wow.
Voila. Espresso martini.
Yeah, can't wait.
And if you notice, it should almost cascade like that Guinness.
Yeah, it is.
Almost like a Guinness.
It goes from, from very light to...
Yeah, so it'll go light
dark.
to dark, and then it'll change as you drink it. So there you are. Cheers.
Cheers. So Deanne, mix this up. I think you will like this.
All right.
You smell the coffee in it.
Perfect. Wow.
Nice way.
Fantastic.
Nice. Yeah. Great coffee flavor.
Just what the doctor ordered.
Yeah. So, there was a time when you came home from work and you probably weren't greeted with something quite this fancy, but at least a martini.
Yeah.
So I'm gonna read a little biography of you here. Dmitry Farberov is a decided underachiever. He graduated cum laude from UCLA and earned both the Chartered Financial Analyst and the Chartered Financial Planner designations. I should say my mother has a certified financial planner designation. It was a load of work, and I understand the chartered designations are even more work than that. So, wow. At Miracle Mile Investors, which is a registered investment advisor with over $2 billion under management, Dmitry personally manages about $80 million for individuals and institutions, including a mixed martial arts champion, the producers of the most popular show on Netflix, and entrepreneurs and founders of some of the most successful businesses in Los Angeles. Over the decades, I've met I don't know how many stockbrokers, financial advisors, wealth managers. What sets you apart from the thousands and thousands of these guys is that you have a philosophy that undergirds your practice. And that's really where I'd like to start is talking about this investing philosophy, because I think that's where a lot of people go wrong. So talk to us about that, if you would.
Sure. I would say investing is very hard. And people think that investing is easy. Depending on when they come into the cycle of the general markets, they think they can just ride a wave and make a lot of money. But countless mistakes over 20 plus years in my life has taught me that philosophy is critical to having long-term success in the markets. Right? Warren Buffett has a philosophy, which means he doesn't flinch when markets turn against him, because he knows that his philosophy is what's going to be, it's going to be standing after all the volatility is done. Most people don't have a philosophy. They defer to others to help them determine what that philosophy is. They focus on the next hot stock or the next hot sector. But when volatility comes into play, and when blood is on the streets, and when they turn on the TV or read the newspaper, and it says, sell because X is going to happen in the world, and you see your portfolio down 10, 20, 30%, and that could be countless hundreds of thousands, if not millions of dollars in my world, that changes people. People don't know how they're going to react under those circumstances. And so that's where, for me, in my personal investing, I've learned to really understand what my core philosophy is, right? It's only when times are really hard that we understand kind of what makes us tick. And I've learned that through all the volatility in the markets over the last 2 decades, whether the great financial crisis or the corona crisis or any periods of volatility in between, clients that don't have a philosophy will fail. 9 times out of 10. And that's where having an advisor is so valuable, who does have a philosophy. But it's important to find that advisor who helps educate you about what your philosophy ought to be, understands what your psychology is, that will really determine how you react to in times of stress. So every individual is different. There are going to be folks that have a philosophy of momentum. There are going to be folks that have a value philosophy. They want to be the contrarian. They want to do what folks are not doing. They want to invest away from the herd. Some have to be a part of the herd. And so that's where it's critical. I think that's what differentiates the quality advisor and the successful investor from that individual who's going to make the mistake that's going to make the difference in long-term returns over time.
So let's take someone who's, let's say, is just getting started in their career. Maybe they've got that first job out of college. So perhaps for the first time in their life, they've got a little bit of extra money. They can, go on a big vacation. They can, spend it on this, or they could, start investing some money. So, what would you recommend for someone in that situation in terms of how they approach you know, investing their money and presumably looking toward the future. Maybe they're not married yet, but you know, hope to get married and have a family, all that kind
Right.
of stuff.
Well, first and foremost, that individual, their number one investment is in herself or himself. I think that's the key. That's going to be the biggest return on principal or on invested capital will be the investment that they make in themselves, their education, and so on. But assuming they have a career and they have ample income and to pay for the day-to-day and they have savings, at that point the value is not in the underlying investment itself, but it's in the process with which someone approaches investing for the long run, which is save. Save as much as you possibly can. And when you have money to save, do it consistently. And then at that point, the question is, what savings, what investment is going to get you the best return on your principal over time? And that it's a question of diversification. That's where philosophy is also important, because diversification is not going to bring riches overnight. Diversification is going to bring riches over 30 plus years. But if your philosophy is one that's not going to be satisfied with slow returns and wealth that's going to be accumulated over a very long period of time, then you have to know that in advance, and then find a strategy that makes sense for you. So that might be investing in angel investing, just as an example. It's more aggressive, but that's going to have a different return characteristic than a diversified stock and bond portfolio. So that's where philosophy is a critical element of things. But in general, I think to get started, you have to just understand how to react to volatility, which is inevitable in any part of our lives. So that's where I tell anybody, get started in the market. Diversify portfolio to one individual might be boring, but to someone who's never experienced any volatility, seeing a 5-10% decline in any amount of capital is significant and will cause you to lose sleep. So get used to that. And then over time, you can diversify into other investments that have a different risk profile.
So how does one determine whether his philosophy is valid or he's made a mistake and actually does need to, you know, readjust his portfolio or you know, change his outlook? How does one determine that?
Right. Well, that depends on a number of factors. The first is, are they doing it on their own, or are they investing alongside somebody else, an advisor? And I think that's a critical element. If you own a bad individual investment and the market turns away against you, you should be able to cut your losses and leave. But you need to know what makes a bad investment, what makes a good investment. And most people don't even ask those questions. Like, when are you willing to exit your investment? If you have a long-term horizon and you've got a diversified portfolio, like in your case, you know that any volatility will be short-lived. It might be a couple of months, days, or years potentially, but it'll, in the grand scheme of things, will be short-lived. But if you have one stock that you own, I know folks that have millions of dollars in Tesla, right? How do you know if Tesla's a quality investment? It's a great car, right? It's a great product, great CEO, but it's an investment that can drop and has dropped 40%. And potentially, if we look back 3 years ago, was on the verge of bankruptcy. If stars didn't align in the right way now, Elon looks like a genius and the company is great. But several years ago, that wasn't the case. So I think it's about knowing why you're investing, how long you're investing, and what the eventual outcome that you want to get accomplished. If you're investing in a single company versus a collection of companies based on global macro trends in general economy, and we know that when you look back over the last thousands of years, human progress is forward. And therefore, the companies that participate in that human progress, if you're diversified in all of them across different asset classes, different geographic regions, you'll be fine. But that's a philosophy, right? That's I'm investing in the long-term growth of society. I want to participate in that, as opposed to a speculation on one stock or one sector that you believe will do well. Robotics as an example. Well, what if trends move away from that direction? How do you know? You have to answer those questions before you come into that investment. And if you don't have those answers, then you're speculating and you will make mistakes, without a doubt.
So, I mean, it's interesting, of all things you brought up robotics. I would think that today it's virtually a given that something like robotics is going to grow and become ever more a part of not just American business or worldwide business, but even here in the home, you have, robotic vacuum cleaners, and you've got Alexa and all these things where, I guess there's not one where you can say, mix me a martini, Alexa, but maybe there will be soon. So what determines, or what kind of information guidelines should we be looking for as we, size up those? So, because even within a macro strategy, we still have to make individual investment decisions, right? I still have to decide whether I'm going to buy, Procter and Gamble, or whether I'm going to buy, Apple. So, where do what kind of guidelines should I be looking for there?
Well, I think there a big factor is, how are you investing? If you're buying individual companies, how are you approaching understanding their balance sheet? Are you buying their balance sheet for future growth? Are you buying it for value relative to more expensive competitors? So most people don't invest based on balance sheet analysis like years ago, like Warren Buffett does or has done. Most people invest in trends, and so that's critical. For example, my clients, they won't know that. I mean, everyone knows Apple, but they won't know the difference between Teladoc and I don't know, Siemens, right? But yet they participate in that growth. Other individuals, they gravitate toward individual stocks that they want to own, and those individuals need to be able to identify markers for success. So if you're buying based on future cash flow, if you're analyzing current cash flow and you're discounting it based on certain interest rates, then you have to understand what factors might change that might change the investment thesis if it's interest rates. So, for example, the NASDAQ, and we're going to get just a little bit wonky here,
sure.
but the NASDAQ is largely, not largely, but a big majority of the names right now are growth names. They're not necessarily creating cash flow and revenue to the investor. Their focus is on growth and reinvesting their earnings over time. So therefore, their future earnings are dependent upon interest rates. So as interest rates go up, the value of Google, for example, is lower if interest rates go higher because they're not paying cash flow to the investor. Whereas so there's a shift currently, for example, going from certain growth names with the expected rise in interest rates to more income names. And so knowing why you invested in Google is critical, or in your case, Procter and Gamble. It's critical to know, are you investing, because there are a lot of factors that play into a return profile. The reality is, these days, most of the return profile is tied to the sector, not to the underlying company. So Procter and Gamble will do more or less as well as Johnson & Johnson, or whatever companies are in the space. But if there's an underlying reason why you like Procter and Gamble over the competition, you want to make sure that those factors continue staying in place and perhaps improving. Are they starting to? Do you have a better CEO? Do you have? Is it market share that you're buying for, and therefore you're looking for market share? But other than that, if you're not looking for, are you doing bottom-up analysis? Are you doing economic top-down analysis? And so there's so many different factors. But the key is, know why you got into the investment in the first place. And so my clients, they could care less about the individual names because they're buying the overall trends. There are other investors on Robinhood, right? So a lot of the younger audience that you have might not be, they're not analyzing the company's cash flow, but they For some reason, that audience has gravitated towards Robinhood. They've gravitated towards crypto, and Tesla and those names. These are momentum investors. That's their personality. For whatever reason, they're attracted to it. And others will say, I can't stand crypto. I don't understand it. I don't want to have anything to do with it. These are the individuals most likely that are more value-oriented individuals, contrarian. And knowing what your gut tells you at these levels is very often an indicator of where you're going to naturally gravitate to, and then how you invest. But the key is you got to study. You have to. I mean, it's a process. People think investing is so easy, and it's probably the hardest thing one can do over time, because human psychology is nearly impossible to really. It's a life's journey, right? To really understand that psychology.
Oh, so I've got about 10 questions I want to ask you, but I have time for only one more quick question. For someone who wants to get started on their investing journey, what would you recommend as being the first thing they should do?
I would say pick up a book on psychology. The one that comes to mind is Daniel Kahneman's Thinking Fast and Slow. It's just really understanding your perception of the world, and that's critical. Of course, it's important to have an understanding of money, just the very basics of money, and there are a lot of great books about the basics of money. But knowing the basics of money is not enough. You have to know what pitfalls you're going to face, and the only way to do that is really understanding your own elements of fear and greed, and how you're going to react under those circumstances.
Say the name of the book again.
So, Thinking Fast and Slow by Danny Kahneman.
Okay.
is probably my favorite book because it's so applicable to any facet of life.
Excellent. Dimitri, thank you so much for coming and talking with us today.
It's such a pleasure. Thank you for the opportunity.
So that's our show for this week, folks. After the interview, I told Dimitri he's just the kind of person I think is ideal for managing investments. Unflappable. I've known him for quite a while, and I tried to even throw a curveball at him, just took it right in stride. So I think we can literally take Dimitri's advice to the bank. Especially his tip on how to get started. The book by Daniel Kahneman, a Nobel Prize winner, Thinking Fast and Slow. I honestly haven't read it. I'm going to pick up a copy because I'm always interested in resources that can help me better understand how we as human beings think and act. Send us a message at our website, thewaytowowshow.com. Tell us what you think about our guests, what you're getting out of it, what you'd like to see. We're always interested to hear your input. Courage at all times, my friends. Marie, you're still my belle, darling.